Hello, this is Peter Cotorceanu. I'm the CEO and founder of gatcaandtrusts.com and of its parent firm, GATCA and Trusts Compliance Associates LLC. I am absolutely delighted to present this introductory training to you on FATCA and CRS. This training assumes no knowledge of FATCA and CRS. It's for beginners. Nevertheless, if you know quite a bit about FATCA and CRS, you will no doubt benefit from this refresher course. Without further ado, let's proceed with the rest of the presentation. Please remember that these materials are copyrighted. They're for your use, and you can use them and view them as many times as you like, but please don't share them outside of your firm. We'll begin with an introduction to FATCA. FATCA stands for the Foreign Account Tax Compliance Act. It's a US law that was passed in 2010. After a couple of delays, it became effective on the 1st of July 2014. FATCA actually consists of 5 different parts. However, it is only Part 1, Increased Disclosure of Beneficial Owners, that most people think of when they think of FATCA. That's because Part 1 is the key part when it comes to automatic disclosure of information. Part 4 also impacts the offshore trust industry, but not in the sense of automatic disclosure of information. Part 4 has a provision that says that if a US person beneficiary of a non-US trust, or if a relative of a US person beneficiary of a non-US trust uses trust property and doesn't pay fair market value for that use, that uncompensated use is treated as a trust distribution to the US person beneficiary. So for example, if a trustee of a non-US trust allows a US person beneficiary or the spouse of a US person beneficiary to live in a house owned by the trust, and the beneficiary or the spouse does not compensate the trust, then that uncompensated use is treated as a distribution to the US person beneficiary. Therefore, if you're in such a situation and you are providing information to your US person beneficiaries about their distributions, you should be including that uncompensated use in the documentation that you provide them. For example, in the foreign grantor trust beneficiary statement or foreign non-grantor trust beneficiary statement that you provide them. Let's put Part 4 of FATCA to the side. The rest of this presentation will focus on Part 1, Increased Disclosure of Beneficial Owners. You can essentially ignore Parts 2, 3, and 5. They deal with other obligations but have nothing to do with the automatic disclosure of information. So what is FATCA's goal? Well, its goal is actually apparent from the title of the legislation, the Foreign Account Tax Compliance Act. FATCA's goal is to ensure that US taxpayers who have accounts overseas, in other words, foreign accounts, are fully tax compliant. To put it another way, FATCA's goal is to find US taxpayers who are trying to hide accounts at so-called foreign financial institutions, or FFIs, and here foreign means non-US. So you can already see that the term account and the term FFI are key terms when it comes to FATCA. Indeed, there is an entire training devoted to the subject of what is an account in a fiduciary structure under FATCA. And we'll spend a considerable time in the entity classification training explaining what is an FFI. So how does FATCA work as a procedural matter? For the moment, we're going to focus on the FATCA statute and the regulations that were adopted under the statute. In a few moments, we'll talk about the Inter-Governmental Agreements, or IGAs. But before the IGAs came out, all FATCA was about was the statute and regulations. Under those documents, foreign financial institutions, FFIs, and here we've depicted a Swiss bank, would report their US taxpayer account holders and information about the accounts directly to the US Internal Revenue Service. Now, people who want to hide from tax authorities often don't want the accounts in their own names. Instead, they'll often create an offshore structure, might be a trust or a company or a foundation, put the account in the structure's name, behind the scenes control the structure, but not have their name on the account. FATCA addresses accounts that are held through structures, and we'll look at how in the coming slides. We've already seen that FATCA imposes reporting obligations on FFIs, foreign financial institutions. Specifically, FFIs are required to report their US account holders and details about those accounts to the IRS. Now, FATCA actually divides the entire universe of non-US entities into two and only two main categories: FFIs on the one hand and so-called non-financial foreign entities, or NFFEs, on the other. In fact, every non-US entity in the world is either an FFI or an NFFE, and no non-US entity can be both. The two categories are all-encompassing but mutually exclusive. The way this works is that FATCA defines FFIs, and there are several categories. If a non-US entity meets any one of the definitions, it is an FFI. FATCA then goes on to say, any non-US entity that is not an FFI is an NFFE. That's why the categories are all-encompassing and mutually exclusive. NFFEs are further subdivided into two categories, so-called active NFFEs and passive NFFEs. In the entity classification training, we'll go into detail as to the distinction between active and passive NFFEs. There are quite a few categories of active NFFEs, but to keep things simple for the present presentation, think of an active NFFE as an operating company. It's active. It's an active business. As I say, there are other categories and we'll look at them later. But for now, if you think of an active NFFE as something that's active and has an operating business, then you should think of a passive NFFE as something that's earning passive income. In other words, income on portfolio assets. And if you can think back to the US taxpayer who is trying to hide behind an offshore structure, the sorts of structures that US persons are going to hide behind, if they are NFFEs, are almost certainly going to be passive NFFEs, earning passive income, not operating companies or any of the other types of active NFFEs. So FATCA, when it comes to NFFEs, is primarily concerned with passive NFFEs. Now, a key point to understanding FATCA is to realize that, as we've already seen, FFIs have FATCA reporting obligations. They must report their US account holders. NFFEs have no FATCA reporting obligations. We will see that passive NFFEs must disclose the US persons behind them, but they don't report any information to the IRS. Rather, they disclose the US persons who control them or who own them to the banks or other FFIs where the passive NFFEs hold their accounts. and those FFIs then report the US persons to the IRS. Another key point in understanding FATCA is that many client structures will in fact be FFIs. This is very counterintuitive. When you hear the phrase financial institution, you naturally think of banks, perhaps asset management firms, maybe insurance companies. But in common parlance, no one would refer to a trust or other client structure as a financial institution. Nevertheless, many client structures will be FFIs, and in the training on entity classification, we'll go into detail as to why this is the case. For now, just realize that many client structures will have FATCA reporting obligations. Another key point to understanding FATCA is that almost all client structures that are not FFIs will be passive NFFEs, and we'll see in the coming slides what that means as a practical matter. This slide depicts what happens if a US taxpayer creates a structure that holds a financial account at an FFI and the structure is a passive NFFE. In the coming slides, we'll look at the situations where the client structure is an active NFFE or an FFI. If a US taxpayer creates a structure that's a passive NFFE, we've already seen that passive NFFEs must disclose to the financial institutions where their accounts are held the US persons that own or control them. So here, in effect, what happens is that the FFI, in this case we've depicted a Swiss bank, looks through the passive NFFE to the US taxpayer or taxpayers behind it. It then reports those taxpayers to the IRS. In other words, passive NFFEs provide no protection from disclosure to US persons with accounts at FFIs. Contrast the situation where an account is held by a passive NFFE with the situation where the account is held by an active NFFE. Active NFFEs not only don't have any FATCA reporting obligations, they also have no obligation to disclose their US persons to FFIs where they hold accounts. This is because active NFFEs, again, think for now of operating companies, are not the sorts of entities behind which US taxpayers hide. Therefore, they don't have to disclose their US owners or controlling persons, and the FFIs where they have accounts don't report the active NFFE's owners or controlling persons. In such situations, there is no reporting of the US persons who are behind active NFFEs. Finally, let's look at the situation where the client structure is in fact an FFI. As we've already mentioned, counterintuitive as it is, many structures will in fact qualify as FFIs. If a US taxpayer creates a structure that's an FFI, and here we've depicted a BVI trust. There's nothing magic about it being in the BVI. It could be a trust, it could be a company, it could be in any jurisdiction. But if it's an FFI that has an account at another FFI, in this case, this BVI trust has a bank account at a Swiss bank, then what happens under FATCA is that the FFI that's closest to the US person does the reporting. The Swiss bank here does not look through the BVI FFI trust. Rather, the BVI trust that's an FFI does its own reporting of its US account holders to the IRS. And in the training on accounts, we'll discuss very specifically what qualifies as an account in a trust that is an FFI. For now, however, just realize that if a client structure is an FFI, it will have its own FATCA reporting responsibilities if it has US account holders. And any FFIs where it holds its own bank accounts, for example, will not have any FATCA responsibilities with respect to the client structure's own quote-unquote account holders. So let's summarize what we've discussed so far. Under FATCA, foreign financial institutions, or FFIs, must report their US account holders to the IRS. And they must look through passive NFFEs and report any US persons behind them. The technical terms are US controlling persons or substantial US owners. And we'll go into what those terms mean when we discuss reporting responsibilities. But for now, however, just realize that FFIs report their US account holders who hold accounts directly with them, and they look through passive NFFEs and report any US persons behind the passive NFFEs. Now let's take a little step back. We've seen that FATCA is a US law. We've also seen that it imposes obligations on non-US financial institutions. Why on earth would a non-US bank or a non-US client structure that's classified as an FFI comply with a US law? The answer is that FATCA has an inbuilt enforcement incentive. In fact, it has a couple of inbuilt enforcement incentives. If an FFI invests in US securities or other assets that produce US source income, and the FFI does not comply with FATCA, the US enforces FATCA by imposing a 30% withholding tax on that US source income. It's a punishment, if you will, for not complying with FATCA. Big financial institutions can hardly afford to avoid the US capital markets by disinvesting in US securities. The other incentive that FATCA gives is that if an FFI invests in US securities and sells those US securities, 30% of the gross sales proceeds, not the profit. Indeed, even if there's a loss, 30% of the gross sales proceeds are withheld as a punishment for not complying with FATCA. Because of the built-in withholding tax incentives that are part of FATCA, most FFIs wanted to comply with the legislation. However, there was a significant problem. Foreign financial institutions, indeed financial institutions generally, are usually subject to pretty stringent banking secrecy, data protection, and privacy laws. In other words, if a foreign financial institution wanted to comply with FATCA because it wanted to avoid US withholding taxes, it wasn't able to do so because it would be liable under its own local legislation for violating the laws depicted on this slide. FATCA, therefore, was almost like a house of cards, and if all that had existed was the legislation and the regulations, it would have collapsed because no foreign financial institutions, or very few of them, would have been able to comply with the law, even if they had wanted to avoid the enforcement penalties. What happened next was that FFIs around the globe began to lobby their own countries' governments and asked that those governments change their laws to allow the FFIs to comply with FATCA and thereby avoid FATCA's withholding penalties. As an incentive for foreign countries to pass such laws, the United States began entering into so-called Inter-Governmental Agreements, or IGAs, under FATCA. Under these IGAs, the US government agreed to lessen some of the burdens that FATCA imposes on FFIs, and in exchange for doing so, the foreign government agreed to change its law to allow FFIs resident in its country to comply with FATCA. There are two basic models of IGA, the so-called Model 1 and Model 2 IGAs. This slide depicts the mechanics of FATCA under a Model 1 IGA. Under a Model 1 IGA, FFIs do not report their US account holders directly to the IRS. Rather, they file their reports to their local country government, which then sends that information to the IRS. The mechanics of a Model 2 IGA are similar to the mechanics under the FATCA statute and regulations. Here we've depicted a Swiss bank. Currently, Switzerland has a Model 2 IGA, although it is in the process of moving to a Model 1 IGA. Under a Model 2 IGA, just like under the US FATCA regulations and statute, FFIs report their US account holders directly to the IRS. They do not report to their local home country government. The US Treasury Department has a list of countries that have IGAs, and it tells on that list what type of IGA the country has, Model 1 or Model 2. The website is at the address depicted on this slide. It is updated regularly. Please bear in mind that if a country is not on the list of IGAs on this website, it does not mean that it's not subject to FATCA. FFIs in countries that don't have IGAs are governed by the US FATCA statute and regulations. As I've said in other presentations, FATCA loves everyone. So all countries in the world are subject to FATCA, either under an IGA or, in the absence of an IGA, under the FATCA statute and regulations. Another important aspect of IGAs, at least with respect to Model 1 IGAs, is that they can be so-called reciprocal. Under a so-called reciprocal Model 1 IGA, the US agrees to send the reciprocal partner country information about its tax residents who have accounts at US financial institutions. A not so well kept secret about reciprocal IGAs is that they're not very reciprocal at all. The US demands a lot of information from FFIs about US taxpayers. However, under a reciprocal IGA, the US promises to give very little information to the IGA partner country. As I've said elsewhere, reciprocal is as reciprocal does, and reciprocal IGAs are not very reciprocal at all. If you want to get more information about what the US promises to give under a reciprocal IGA, read the article called Hiding in Plain Sight. It's available on the gatcaandtrusts.com website under Publications and then Articles. In there's a table that sets forth exactly what the US demands from other countries and exactly what it promises to give. That information is depicted on this table, but please read the article for all the details. Now let's summarize the key points on FATCA. FATCA is a US law. Under FATCA, every non-US entity in the world is either an FFI or an NFFE. NFFEs are further subdivided into two categories: active NFFEs and passive NFFEs. Although active NFFEs are more nuanced than is depicted on this slide, for present purposes, think of an active NFFE as an active operating business, the sort of structure behind which taxpayers don't hide their money. On the other hand, think of a passive NFFE as an offshore entity created for perhaps the precise purpose of hiding undeclared money. It invests in bankable assets and earns mostly passive income. As we have seen, FFIs must report their US account holders and the US controlling persons and substantial US owners of passive NFFEs. NFFEs themselves have no FATCA reporting responsibilities. However, in order to enable FFIs to fulfill their reporting responsibilities, passive NFFEs disclose to the FFIs where they hold accounts their US controlling persons and substantial US owners. Another key point with direct impact on the offshore fiduciary industry is that many client structures will be FFIs with their own FATCA reporting obligations. Most of the rest of client structures will be passive NFFEs, which will be looked through for any US persons behind them. These are, in fact, the two biggest impacts of FATCA on the fiduciary industry. Over 100 countries now have FATCA Inter-Governmental Agreements, or IGAs, with the United States. For an up-to-date list of those countries and the types of IGA they have entered into, see the US Treasury Department website that was depicted on an earlier slide. If a country has an IGA, FFIs in that country are governed by that IGA and local implementing legislation. They are not governed by the US FATCA statute and regulations. In contrast, FFIs in countries not covered by an IGA are governed by the US FATCA statute and regulations. At this point, you should have a basic understanding of how FATCA works. FATCA is US legislation, the goal of which is to require non-US financial institutions to report US account holders. It has a subsidiary goal of looking through offshore entities that might be used to hide US taxpayers, so-called passive NFFEs. In the next part of this training, we will look at the so-called Common Reporting Standard, or CRS, also known as GATCA, which is short for Global FATCA. At first, many countries were resentful of FATCA. They entered into IGAs because they wanted to get rid of the withholding penalties that would be imposed on their FFIs if they didn't comply with the regime. However, they saw FATCA as a US imperialistic diktat imposed by fiat on the rest of the world. After a while, however, some countries began to think differently. They thought maybe the US is onto something. Maybe we should have an equivalent to FATCA. The next logical step, therefore, was to take FATCA and make it global. That's, in fact, where the acronym GATCA comes from. As I've mentioned already, it's short for Global FATCA. The Organization for Economic Cooperation and Development, or so-called OECD, which sits in Paris as a non-governmental organization, was asked to come up with a global version of FATCA. This version of FATCA would not be US-centric. Rather, non-US countries could exchange information about their respective tax residents with accounts in each other's country's FFIs. The OECD eventually published a book called the Standard for Automatic Exchange of Financial Account Information in Tax Matters. It is available at the website on this slide. This book, sometimes called the Standard, is also often referred to as the Common Reporting Standard, which is abbreviated CRS. GATCA, short for Global FATCA, is in fact a better acronym than CRS. This is apparent from this slide. The publication of the OECD consists of several parts, and they're depicted on this slide. It has an introduction, which is approximately 10 pages long. Then it has a Model Competent Authority Agreement, or MCAA. The initial version of this agreement in the booklet is bilateral. It's approximately 10 pages long as well. The next part of this booklet is the Common Reporting Standard, or CRS, which is approximately 30 pages. Then follow commentaries on both of the above, in other words, the MCAA and the Common Reporting Standard. Those commentaries are extensive. They amount to about 140 pages. And then there are several appendices that are about 100 pages in total. If you look at the slide then, you will see that the Common Reporting Standard is but one part of a much larger publication. That's why it's confusing to refer to the whole document as the Common Reporting Standard, or the CRS. This is why I personally prefer GATCA as an acronym for this booklet. Nevertheless, most people refer to the entire regime encompassed in the entire book as CRS. And throughout the rest of this presentation and the other training materials, we will interchangeably refer to the OECD's publication as both CRS and GATCA. Another important OECD publication is the so-called CRS Implementation Handbook. It's available on the website depicted on this slide. It's addressed to countries that are implementing CRS, and it gives them practical guidance as to how they should implement that regime. The OECD has also published a list of CRS FAQs. Some of those FAQs are published in the CRS Implementation Handbook. However, the OECD has published FAQs subsequently to the publication of that handbook, and all of the FAQs are available on the OECD's website independently of the handbook. It bears remembering that the OECD Common Reporting Standard is not legislation. It is a proposal by the OECD that countries adopt the so-called Common Reporting Standard. As of the 26th of July 2016, 101 countries had committed to do so. They are divided into two main groups. The first are the so-called early adopters, which are listed on this page. They have agreed to exchange the first reporting beginning in 2017. CRS has already gone live in these countries to the extent that FFIs in these countries are already collecting data about their account holders. The remaining countries that have agreed to implement CRS are so-called fast followers, or second wave countries. They have agreed to begin reporting in 2018 and to begin implementing data collection procedures in 2017. They are depicted on this page. In many respects, CRS is a mirror image of FATCA, and in particular the Model 1 IGAs. The goal of CRS is to find local resident taxpayers who are hiding their accounts in overseas financial institutions. You'll see the big X on this slide through the word foreign. That is because foreign is a FATCA-specific term and means non-US. Under CRS, the foreign is often dropped from the acronyms, so instead of referring to FFIs, CRS refers to FIs, which is short for just financial institutions. The CRS book contains both a bilateral Model Competent Authority Agreement and a multilateral Model Competent Authority Agreement. A few countries, for example Hong Kong and the Bahamas, are pursuing the bilateral approach. Most countries are pursuing the multilateral approach. It does make a significant difference which approach countries adopt, as we shall see in the coming slides. As mentioned, most countries have decided to go the multilateral MCAA route. As of August 19, 2016, 84 countries that have agreed to adopt CRS have signed the Multilateral Model Competent Authority Agreement. However, it is important to understand that signatories to that agreement do not necessarily agree to exchange information automatically with every other signatory to the agreement. It's helpful, in fact, to think about signing the agreement as getting a ticket to a dance. It gets you into the dance hall or club, but it does not pick your dance partner. Once a country has signed the Multilateral Model Competent Authority Agreement, it still must agree bilaterally with other countries to implement CRS. In other words, signing the agreement isn't self-executing. Now, the truth is that the process of agreeing with other countries who have signed the MCAA is very simple. The two countries enter into a memorandum of understanding or some short-form document, essentially saying, we're on board, we are dance partners. So the process is simple, and signing the Multilateral Competent Authority Agreement enables that simplified process. But again, it does not guarantee that you, having signed the agreement, are going to exchange automatically with every other country that has signed the agreement. In effect, then, all CRS agreements are bilateral in nature. Even the signatories to the Multilateral Model Competent Authority Agreement have to have a side agreement agreeing to implement with each other. The real difference between the Bilateral Model Competent Authority Agreement and the multilateral version of that document is that bilateral countries have to actually execute a full agreement, and that takes a lot longer than signing a side agreement under the multilateral approach. Countries that have agreed to adopt the bilateral approach, therefore, will generally take a lot longer to implement CRS than those countries that have adopted the Multilateral Model Competent Authority Agreement. But the truth is that it depends on each country how fast they are willing to accept other countries as CRS partners. Now, the one exception to all of this is the EU. The EU has the so-called Directive on Administrative Cooperation, or DAC. That document implements CRS EU-wide, and under the EU DAC, all EU countries are automatically obliged to exchange information with all other EU countries. CRS works very much like the Model 1 FATCA IGAs. If a resident of a CRS country has an account at an FFI in another country, that FFI will report that taxpayer to its home country government. The home country government then sends the information to the taxpayer's home country government. All of this assumes, of course, that the country where the FFI is located has a CRS agreement with the country where the taxpayer is resident. Just like under FATCA, CRS addresses a situation where a taxpayer tries to hide behind an entity and have an account at an FFI held in the entity's name, not in the taxpayer's name. Also, just like under FATCA, CRS divides the entire world of entities between FIs and NFEs. Notice that the word foreign is dropped, So an FFI under FATCA becomes an FI under CRS, and an NFFE under FATCA becomes an NFE under CRS. Similarly, just as under FATCA, CRS divides NFEs into two categories, active NFEs and passive NFEs. Indirectly held accounts are treated essentially the same way under CRS as they are under FATCA. This slide depicts an account that is held by an FI with a taxpayer trying to hide behind it. In this case, the FI, if it is in a CRS jurisdiction, sends its home country government information about the taxpayer, and that home country government sends the information to the taxpayer's country, again assuming that there is a bilateral agreement between the two countries. FI, where the account is held, here a Swiss bank, won't do any reporting because the FI client structure itself is reporting. Also, just like under FATCA, if a client structure is a passive NFE with an account at an FI, the FI must look through the client structure and report the persons behind it, again assuming that its home country has an agreement with the taxpayer's home country. Now there is a special rule under CRS that does not apply under FATCA. And that is if the client structure is an FI and a particular kind of FI, specifically a so-called managed investment entity FI. If that sort of FI is in a non-participating jurisdiction, a country that has not agreed to implement CRS, then it's treated as a passive NFE under CRS. It is looked through, and the same reporting rules apply as described earlier. The FI where the account is held will report the taxpayer to the FI's home country government, which will then share that information with the taxpayer's country, assuming a bilateral CRS agreement is in place between the two countries. The reason for this special rule is that a managed investment entity FI in a non-participating jurisdiction won't in fact be doing any reporting. And therefore CRS says, well, let's treat it as a passive NFE. Let's not just look to the fact that it's an FI and say, well, FIs do reporting. This one won't. But again, this treatment is limited to so-called managed investment entity FIs. Without getting into any of the details, suffice it for present purposes to say that if a client structure is an FI, in all likelihood it will be a managed IE or investment entity FI, and this rule would then apply if it were in a non-participating jurisdiction. Now, before closing this training, let's summarize the key points under CRS. GATCA or CRS is based on the FATCA Model 1 IGAs. FIs must report account holders who are residents of partner CRS jurisdictions, and they must report controlling persons of passive NFEs who are residents of partner CRS jurisdictions. Just like under FATCA, NFEs have no CRS reporting responsibilities. Just like under FATCA, many client structures will be FIs under CRS, and as FIs will have reporting obligations. Almost all of the rest of client structures will be passive NFEs, which will be looked through for any controlling persons behind them. These are the two biggest impacts of CRS on the fiduciary industry. CRS contains a special rule that treats managed investment entity FIs in non-CRS jurisdictions as passive NFEs. Over 100 countries have now agreed to adopt CRS, some with reporting beginning in 2017 and others with reporting beginning in 2018. Thanks for your attention to this training. I hope you have found it helpful. The next training is on jurisdiction selection. It's a critical topic because you must make sure that you're applying the correct rules if you're going to properly implement FATCA and CRS. In the meantime, I wish you much success with your FATCA and CRS implementation.